Hello guys, today is Friday, January 24th. It's time again to evaluate our portfolio and positions, and I will answer a couple of questions from our Discord channel. So as usual, let's see how our portfolio looks, and let's talk a little about market. Market is up from approximately, right now it's approximately 100 points from previous Friday, and volatility went down just 1 point from 16 to 15 right now. Well, our portfolio performed as expected, maybe a little bit less, we will talk about that. Now let's see how it's look like. Our total portfolio of ES positions, which if you follow all of them, it's approximately for 250-300,000 account size of tested trade, has a delta approximately 20 right now for SPX, which is 200 for SPY, little bit less than 0.1%, which is fine because market is went up, and I don't think it has a power to go much higher. Probably we're gonna go sideways or even retrace a little, so it's not a problem right now for smaller than expected portfolio delta. But if it didn't retrace back, we will continue to do what we usually do. We will roll our naked puts up and out and add cheap right now hedges. So let's see how our positions look like now, separate. I didn't talk last time about our Balalaika trade, which is in good shape, and we did roll this week to, let me see, to 56 DTE right now. It was 58 or 59 when we did roll. It has about 6 SPX 6 or 60 SPY positive delta. It's pretty good theta, about 75. It looks very safe, and hope we will continue to make good profit from it. So just to remind, we roll it up and use approximately half of our credit which we got from that roll to add vertical additional vertical hedge at 147 DTE right now. It was 500 points wide. But again, if your account is less than that, you can definitely use narrower spread. Just as a rule, you should use approximately 50% of your total credit which you get from your naked put roll. What else? Let's talk about our violin. We have V7, which is now it's pretty profitable. Our shorts at 35 DTE and delta little bit less than 5. If you remember our rule to roll our longs 100 points down to increase profitability of our trade, if we have our short puts less than 30 days till expiration and delta should be less than 5. Now delta is less than 5, but we still have 35 days till expiration, so we're probably gonna roll that long next week. But again guys, that rule could be bended if your portfolio total delta is less than you need to have. You can do that roll little bit earlier just to get to bump up little bit your portfolio total portfolio delta. Also we have V8 position which we opened just this week. It shows small profit, about $130. It's too young, and we will see how it will develop. Our shorts at 56 DTE. Now it's delta approximately 7.3. Yeah, it's good trade. We will see how it's performed and adjust accordingly if markets start moving down, as we usually do with our Valiant trade. Now it's time to talk about our CDH strategy. Let's first see our just hedges, CDH1, CDH2 and CDH3. It has altogether three of them about $1,000 loss, which is fine because market went up and it is a hedge and it should lose money if market going up. Point of this hedge, it will lose much less than regular our vertical hedges. This is purpose to use that hedge. So it's just 450 right now, but if we check it together with our income positions, which is income 1, income 3 and income 2, altogether has a pretty good 2,200 in profit. But again, we should evaluate that trade with remaining hedges of A, B and C ladders, which we stop using, but we still use that hedges for this new strategy until they will be expired. Let me add all of them and see how they look like together. So this is how it's look like. Our total delta is around 8, which is fine, and theta is 120. I like it. So how it look like, we will continue to do what we do. We will continue to roll our income short puts when it's let me see the closest one, by the way. If we take them out, it should be income 1, right? So income 1, we have 42 days till expiration and delta 4.5, so it's cost more than $9, so it's still time to hold it. But if it dropped below delta 3, we could roll it up and maybe out, or maybe same expiration, we will see, to do it safe. That's it. Let's talk about our wheel position, which we use with MES, micro ES options. So if you remember, we have 3 expirations. The first one is just 7 days left, and we reach our tail profit. Very nice, about $800 in profit. Remind to new people who watching it, we use here in OptionNet Explorer ES to show that position, just because OptionNet Explorer doesn't have micro ES options yet. Maybe it will do it in the future, but not now. So we use ES, so you have to divide that number just by 10. So it is about $800 in profit. We have small negative delta, which helping us to protect our longer term structures, which is the second one, third one. This one is MES 2, the MES 1 we already closed. MES 3 is 28 days till expiration. It also has small negative delta. If you remember, this week we closed a couple of naked puts to make it negative delta. Why? Because we also reach tail profit here, about $330 in profit right now, to protect our next most vulnerable structure, which is MES 4, and it is right now at 56 days till expiration. This is how it's looked like. It's in good profit also in $200. It's just 18 days since we opened the first ratio. After that we add a couple of more. On Monday, if market will be in good shape, not collapsing, we will probably add one more. Because again, it's quite safe, and we have also two other expirations which has small negative delta, and it will protect this structure even more. Also, if you remember, we close our oil position with good profit, approximately $500. We also reach our tail profit and open this week the new one. It has small profit, about $46. It's just, we did it yesterday, we just opened day ago, so we will see how it will develop. If oil will start going down, we will adjust it or add one more, we will see, or roll our shorts same way as we usually do. Two of three we will roll down, increase amount, and make it safer. What else? We have TLT position, which is after TLT bounce up. It's in good shape now. Let me see how you probably know that OptionNet Explorer for some reason doesn't update price of TLT right away. So it's now show, yeah, it's show 87.5, but real price right now 87.2. That's pretty close. So we are in profit, which is good. Plus you have to add here dividends, which you already got 1 month. And this is what we're gonna continue do. We will try to, when the closest our options has 28 days till expiration, we have 3 shorts and short calls and 1 short put. We will continue to roll them or add them to reduce cost of our 200 points longs shares to make it more profitable and get dividends. That's it. That's what we have from our position. It was a very good week, and probably is not as good as we expected, especially for last couple of days. Even market going up and our portfolio delta is positive, but market is not performing for last couple of days, and I saw a couple of questions about that. I just would like to say, because we have too many already calendarized structures in our portfolio. It's CDH and our Vega hedges. And remember, because we have different expirations for long and shorts, volatility of different expirations, they're breathing against each other. So they're changing, they don't change same way as VIX changing. Sometimes our short DT, which are usually longs, IV decrease more than our long-term options, and that structure performing less I mean, worse than it should, and sometimes it's not. So, but good news, I mean, it's hard to predict how they will, what gonna be relationship between IVs of long-term and short-term options. But good news, that trend is usually don't last for long. So it's definitely gonna change. If it's changing against our favor, sooner or later it will change back. So we shouldn't worry about that. And the last, what I would like to talk about, again, our CDH hedge. Looks like it's a lot of confusion here and misunderstanding. People continuously talk about additional Vega risk because we have our shorts one more than our longs. But let's talk about that. I would like to open, let's go on this, yes. Let's open that new trade and see how it's look like now. So we're gonna buy 147 DTE longs approximately at delta 10. Yeah, it's 5,250 strike. We buy 3 of them and sell against it shorts 30 days out. It's approximately 180 DTEs. Right now we have 175, 400 points lower, so it's gonna be 48.50. And do one more, -4. So this is how it looked like. What the cost of that? Well, surprise, it's actually credit, approximately $3 credit. Yes, we have small, not huge, small Vega risk here. Why? Because we have one more short put. But I don't think that, first of all, that risk is big, because it's 180 DTEs. It's too far, and we know when market get crazy and VIX is going up, usually short-term options go, VIX IV of short-term options go higher much more than longer term. So it is not very risky. Second, for some reason people forget, I continuously explain them that when we open this hedge, we go and improve our old hedges, where approximately in 90 DTEs. How we improve that? We close at least one short put, cheap one, which is approximately at delta 1, it should cost less than $10. And this way, we not just increase our Vega risk, we reduce it. Why? Because you know that 90 DTE options much more vulnerable to Vega risk than 180 DTE. So if we go to 90 DTE right now, I see 96 DTE April 30th, and go and just buy one long. In this case, it's 4,300 at delta approximately 1.9. So this is how actually our structure look like. It's no Vega risk at all. Zero. It's even less. We can check it here. Even OptionNet Explorer show Vega positive 32. But it's also because our longs is shorter term, it's even better if volatility increase. Why we doing it this way? Because it's much less expensive. than just vertical hedges. Virtually, for same price, we can open 3 hedges and it will cost you the same as 1 hedge of vertical. It's much more efficient. And if it is confusion for you, calendarized structure of our CDH, it's not a problem. You can do it different way. I will show you another structure which you probably gonna love. Let's open just our delta hedge, which we already familiar with, 180 DTEs, same way as we do it before. We open longs, 2 longs at delta 10, but in this case we're gonna sell 3 shorts, not 500 but 400 points below. Let's go and check. 4,800 minus 3. How much that hedge cost? Very little. Right now it's approximately debit just 6. Well, it is very dangerous. It's not efficient hedge, you can say, because delta is just minus 1, volatility increase, we have bigger risk. But if you go again to 90 DTE and open just one long at cost about 8, this is how it look like now. Is it good? Yes, it's much better than vertical because it's less expensive. We got virtually 2 verticals, because even 3 verticals, because we have 3 longs, 3 shorts, but cost will be less just than 1 vertical hedge. So again, if calendarized structure of our CDH confusing for you, feel free to use this kind of hedge. Just open regular delta hedge, which we usually do, but long-term 180 DTE. In our case, to make it less expensive, use 400 points between long and shorts instead of 500. And open 1 long, but it could be open 1 long, or you can close 1 short of existing hedges which you already have approximately in 90 days till expiration. It will be the same thing. My point is, guys, I am trying to push you slowly to stop evaluating your separate trades one by one. You have to think for and evaluate whole your portfolio at the same time. When we improve our existing hedges and open CDH, or in this case delta hedge 180 DTE, for portfolio, Vega risk is not increasing, it's decreasing, it's reducing, because we buy 90 DTE long to compensate for that, which is much more vulnerable for Vega risk. This is how we're gonna do that. If you have questions and if you don't understand that, again, you can ask more time. I will explain you in Discord channel and show you examples. One more time, you asking which hedge we should improve. Doesn't matter. For portfolio point of view, doesn't matter. Any of them. If you just close 1 short of any of your existing matured hedges, which should be much less expensive than your shorts which you sell at 180 DTEs, it will improve your Vega risk, it will give you much better hedges for less price, but more hedges at the same time. Do it this way. I hope you will like it. Thank you very much, guys. Have a good weekend and see you next week.